Yesterday was first notice day for the May 2026 silver contract on COMEX. Going into yesterday morning, 26,963 May contracts were still open. That's about 135 million ounces of potential delivery demand, sitting against 77 to 80 million ounces of registered silver in approved warehouses. Coverage ratio, 13 to 14%, below the stress threshold for 6 straight months. Most of those contracts will roll forward like they always do. That's normal. Most years, this is a quiet day on the calendar. This year is different, not because of one number, because of the pattern. January saw 3,345 million ounces physically withdrawn from COMEX vaults in 7 days. That was 26% of the deliverable pool, gone in a week. Silver hit $120 the same month, then crashed back to $75 after the CME hiked margin requirements. The pool that got drained never refilled. It went into first notice day yesterday, smaller than it was when January started. February delivered 2518 million ounces, highest February delivery in modern COMEX history. March delivered 52.63 million ounces, taking 86.4% of registered inventory in a single delivery month. The 2-month delivery pace from January through March was the fastest in exchange history. Today is Friday, May 1st, 2026. Silver is trading near $75. Gold is around $4,800. The Fed wrapped up Powell's last meeting as chair on Wednesday with the sharpest descent in 34 years. The Strait of Hormuz is closed because of the Iran war. Brent crude is above $110. And this morning, the silver delivery report from yesterday's first notice day landed. I want to walk you through what's in it, what it actually means, what's signal and what's noise. And the one thing I keep coming back to that I think most retail investors are going to miss, this isn't financial advice. Silver dropped 38% in 90 days from $121 to $75. It can do that again. Talk to a qualified advisor. Do your own research. I'm walking you through what the data is showing. Quick foundation, because the headlines about COMEX delivery don't make sense unless you understand the mechanics. A futures contract is a paper claim. When you buy a May silver contract, you've bought the right to take delivery of 5,000 ounces of physical silver during the May delivery window. First notice day is the day that window opens. Contract holders make a choice. Take physical delivery, roll the contract forward to a later month, or close it out for cash. In a normal market, almost nobody takes delivery. Historically, 97 to 99% of contracts roll or settle in cash. The metal isn't really the point. The contracts get used for hedging and speculation. Real silver in the vault is almost a formality. That assumption only works as long as nobody actually demands the metal at scale. Here's what early 2026 has looked like. January 2026. Delivery rate spiked toward 5 to 10% of contracts, way above the historical 1 to 3%. 33.45 million ounces left COMEX vaults in a single week. The CME stepped in with margin hikes that crashed silver back down. February 2026, 536 contracts delivered, 2518 million ounces, the highest February delivery on record. First notice day alone saw 1,881 contracts stand for delivery. That's 37% of the entire month's delivery happening on a single day. March 2026, 10,526 contracts, 52.963 million ounces. The exchange delivered 86% of its registered inventory in 2 months, while speculator positioning collapsed 78% year over year. So when yesterday's first notice day for May arrived, the system was already strained. The pool of deliverable metal was smaller. The pattern of front-loaded deliveries on day 1 had been established for 2 consecutive months, and the institutional behavior had shifted from roll the contract to I want the metal. That's the context for everything that follows. Now the part that matters most. Who's actually delivering and who's taking delivery? When a bank issues a delivery notice, it can come from one of 2 account types. The customer account, where the bank is acting as a middleman for clients, or the house account, where the bank itself owns the metal on its own balance sheet. Customer account deliveries are normal. Banks are middlemen all the time. Clients buy contracts, banks help facilitate the delivery. Most month-to-month delivery flow happens this way. House account deliveries are different. When a bank issues from its house account, it's the bank's own metal leaving the bank's own vault. That's a balance sheet decision. Banks don't voluntarily hand over their own inventory unless something's pushing them. Looking at recent delivery patterns across the early 2026 cycles, you see a recurring story. Standard Chartered has been one of the largest sellers across multiple delivery months. JP Morgan, BNP Paribas, and HSBC have been active too. On the buy side, Scotia Capital, Macquarie, and RBC capital markets have been consistently stopping contracts. Several of these are house account moves. This pattern, where the same banks keep delivering and the same banks keep stopping for delivery month after month, is structurally interesting. It looks less like normal market churn and more like a coordinated rotation of physical metal from one set of hands to another, bullion banks delivering, other major institutions taking the metal off the exchange and into their own vaults. What makes that genuinely unusual is the consistency. In a healthy market, customer accounts dominate the delivery flow. House accounts are episodic. When you see house accounts repeatedly issuing significant volumes for several consecutive months, you're watching banks reduce their physical positions by choice or under pressure. Honestly, this is the part of the silver story that almost no one in mainstream financial media is willing to cover. It requires explaining bank balance sheet mechanics on television. It requires admitting that the people who report the spot price might also be the people unloading inventory. CNBC isn't going to do that. The data is public. The CME publishes the delivery reports daily. You can read them yourself. Most retail investors have no idea this information exists, let alone that it tells the actual story underneath the screen price. Look at what's happening to open interest itself. In 2020, total COMEX silver open interest was above 220,000 contracts. The paper market was crowded, speculators everywhere. Going into yesterday's first notice day, total open interest was around 110,000 contracts, the lowest reading since March 2012. After yesterday's roll activity processes through the system, we're likely sitting near or below that level. That's a 50% drop from peak, cut in half over 6 years. Here's what most retail commentary gets wrong about this. Falling open interest gets read as bearish. The thinking goes, fewer contracts means less interest in silver. People are giving up. That reading misses what's actually happening. Speculators are leaving. The traders who use the COMEX paper market for short-term betting are gone or going. Managed money positioning collapsed 78% year over year. The casino is emptying out, but the metal that's leaving the exchange isn't going back into circulation. It's being delivered to industrial users, to bank house accounts, to allocated institutional vaults. Silver that used to sit in the exchange backing paper contracts is being pulled out into private storage by people who actually want to hold it. That's a structurally different market than what was operating in 2020. The paper market is shrinking because the people who used it for speculation don't trust it anymore. The physical demand isn't shrinking. It's shifting from paper claims to real metal. The CME has been responding to the open interest drop the way exchanges always do. They cut margin requirements, lower the cost to hold leveraged positions, make it cheaper to trade. The hope is that lower margins lure speculators back in. It's not really working. The trend has been one direction for months, down. Speculators aren't coming back to a market that just demonstrated the exchange will hike margins on you the moment your position starts working. I keep coming back to this. The CME hiked margins in late January after silver hit $121. That hike forced leveraged longs to liquidate. Silver crashed 40%. Then the same exchange cut margins a few weeks later, trying to bring people back. If you're a paper silver trader, why would you trust that round trip again? You wouldn't, so you don't come back. And the open interest keeps falling. While COMEX is doing what COMEX is doing in New York, there's a parallel story playing out in Shanghai. And honestly, the China side might matter more long term. Combined Chinese silver inventory across the Shanghai Futures Exchange and Shanghai Gold Exchange peaked above 7,000 metric tons in January 2021. Today, it's under 1,300 tons, a drop of more than 80% in 5 years. In ounce terms, roughly 184 million ounces of silver has drained from accessible Chinese vault storage since the 2021 highs. Vanished. Some analysts will point out that Shanghai inventory has bumped up modestly over the past month. That's true. The 5-year trend is still down 80+%. The recent uptick doesn't change the bigger picture. Here's what most retail investors miss about the China data. China is the world's largest silver consumer. Their solar panel industry alone consumes about 20% of global annual silver supply. They make most of the world's electric vehicles. They dominate global electronics manufacturing. All three of those industries are silver intensive and growing. When China's vault stocks are this low, it means physical silver coming into the country gets consumed almost immediately. There's no buffer. The just-in-time inventory model that works fine when supply is abundant becomes very fragile when supply tightens. China imported a record 836 tons of silver in March 2026. And that's 173% above the 10-year seasonal average for the month. Year-to-date imports are the highest on record. Some of that surge was timing. The April 1st solar tax rebate deadline pulled industrial demand forward. April and May import numbers will likely come down sharply as that front-loading reverses. When those numbers print, headlines will say, Chinese silver demand collapses. Treat that with skepticism. It's mostly just timing reversing. The structural picture is what matters. Chinese vaults at 80+% below their 2021 peak. Industrial demand growing. The world's largest silver consumer with no inventory buffer. Two exchanges, one continent apart, telling almost the same story. New York running on declining physical inventory, Shanghai running on basically empty. The paper market is the last place reflecting this reality, because paper contracts can be created with a keystroke Physical metal cannot. For the next 30 days, here's what matters. Watch the COMEX daily registered inventory reports. The number to track is whether the registered pool grows back, stays flat, or keeps shrinking through May. Each day's report shows withdrawals, deposits, and reclassifications between eligible and registered status. Below 70 million ounces of registered inventory by mid-May would be a real warning. Below 65 million ounces is escalation. Watch the May delivery completion percentage. First notice day initiated the cycle, but deliveries continue through the entire delivery month. If May ends with another 30+ million ounces delivered, that's 3 consecutive months of historic delivery pace. The system can't sustain that rate indefinitely without either rebuilding the pool or letting paper prices reset higher. Watch the Shanghai premium. Physical silver in Shanghai has been trading at premiums of 10 to 15% above Western paper benchmarks for most of 2026. If that gap widens above $15 per ounce, the paper physical decoupling is accelerating. If it compresses back toward normal, the immediate squeeze pressure is easing. Watch the Fed's June meeting. Powell's last FOMC was Wednesday. The dissent vote was 8-4, with 4 members publicly disagreeing for the first time since 1992. Stephen Moran wanted a cut. 3 others wanted neutral language acknowledging hikes might be needed. Markets repriced to 0 rate cuts for the rest of 2026. Kevin Warsh is advancing as next chair. The June meeting will be his first chance to influence policy. Whatever he signals about cuts, hikes, or holds at that meeting matters more for silver than almost any other catalyst. Watch the Iran situation. Trump canceled peace talks last weekend. The Strait of Hormuz remains effectively closed. Iran's foreign minister flew to Moscow to meet Putin Monday. Brent crude above $110. Pentagon estimates 6 months to clear Iranian sea mines from the strait. Any further escalation amplifies safe haven demand for silver and gold. Any genuine de-escalation weakens it short term but doesn't change the structural picture. Some honest framing depending on where you sit right now. If you bought silver in the 40s or 50s during 2025, you're in significant profit even at $75. Your psychological challenge is fear of giving back gains. Watching $121 fall to $75 creates a nagging voice asking if you should have sold at the top. The data we just walked through doesn't say the structural story is over. It says we're in a consolidation held down by specific macro headwinds tied to specific events with specific endpoints. Selling here is a bet those headwinds are permanent. The data doesn't support that bet. If you bought between $80 and $121, you're showing a paper loss. Your challenge is the temptation to convert an uncertain paper loss into a certain real one just to stop the discomfort. Silver moved from $31 to $121 in 12 months last year. If the structural forces that drove that move are still intact, the question isn't whether the price recovers. It's whether you have the patience to be there when it does. If you're considering adding at $75, your challenge is doubt. After a 38% drawdown, buying more feels like ignoring the evidence the market just handed you. Silver has tested support twice in the $67 to $74 zone. That's a double bottom in technical terms. In a structurally tight market with this many confirmation signals, that's typically a base. But sizing matters more than timing. Silver moves 3x gold's percentage in either direction. Whatever you put in, size it so you can hold through another 20% drawdown without panic, because that's possible, even in a structurally bullish market. One more thing about ownership. If you're holding silver through ETFs like SLV, read the prospectus carefully. Most silver ETFs hold a mix of allocated and unallocated silver. Allocated is specific bars in specific vaults with the fund's name on them. Unallocated is essentially a paper claim. In a true squeeze where physical supply runs short, paper and physical can decouple sharply. The ETF can fall while physical premiums spike. If you own silver as squeeze protection, the form of ownership matters as much as the position size. I won't close without naming the risks, because anyone selling you only the bull case is selling you something. The China import surge was partly timing. The April 1st solar tax rebate deadline pulled demand forward into March. April and May numbers come down. Headlines will read bearish, even though it's just calendar effects. Prolonged stalemate is real. Iran could stay frozen for months. Oil stays elevated. Inflation stays sticky. Fed stays on hold. Silver grinds sideways between $72 and $83 for 6 months. That tests patience hard, a hard landing risk. If the Fed's continued rate hold tips the global economy into actual recession, industrial silver demand falls faster than investment demand rises. About 60% of total silver demand is industrial. Silver could revisit $60 to $65 before monetary easing eventually stabilizes it. Narrative reversal. If crypto, AI stocks, or another asset class absorbs the capital that would otherwise flow into silver, the investment thesis gets delayed, possibly by years. Bitcoin pulled massive amounts of capital out of precious metals from 2017 to 2021. It can happen again. Hold these alongside the bull case. That's what real analysis looks like. Not a straight line up. An honest accounting of forces on both sides. Here's where we are. Yesterday was first notice day for May silver. The COMEX coverage ratio sits at 13 to 14%. Below, stress for 6 straight months. The 2-month delivery pace from January through March was the fastest in COMEX history. Bankhouse accounts have been issuing significant volumes for consecutive months. Open interest at 14-year lows. Speculator positioning down 78% year over year. China's combined silver vaults are down more than 80% from their 2021 peak. The world's largest silver consumer is operating with almost no inventory buffer. March imports hit a record. Year-to-date imports the highest ever recorded. 6 straight years of structural global silver supply deficit, totaling 762 million ounces of cumulative drawdown. Another 46.3 million ounces projected for 2026. No major new mine supply coming before 2033. Silver sits at $75. Gold at $4,800. Bank of America has a bull case to $309. Citigroup target $150 to $170. The Reuters analyst poll consensus for 2026 average was just revised up to nearly $80. The mainstream narrative says silver had its move and the story is over. The data doesn't support that. The data says the paper market is shrinking, the physical market is tightening, and the gap between the two is widening every month. Honestly, I genuinely don't know how this resolves in the short term. Could be a quiet May where most contracts roll and the squeeze pressure eases. Could be another delivery month at historic pace that drains the pool below 65 million ounces. Could be a Fed pivot in June that rips the dollar lower and unlocks a leg up to $90. I'm not trying to sell you certainty I don't have, but I am going to tell you the structural picture is clearer to me now than it has been at any point in the past decade. The COMEX paper market is structurally smaller than it was. Bankhouse accounts are repeatedly issuing physical. Chinese vaults are nearly empty. Industrial demand is structurally rising. New mine supply is years away. The price doesn't reflect any of it yet. Drop a comment with your read on yesterday's first notice day. Did the delivery numbers surprise you? What's your year-end silver target? I read every comment, and the discussion in the comment section is genuinely the best part of running this channel. If this breakdown helped you understand a setup that the financial media is missing, hit subscribe. Share it with one person you know who's holding silver and trying to make sense of this market. The next 30 days have May delivery numbers, the June FOMC underwash, China-April import data, and whatever Iran does next. I'll be here breaking down every one of them. The video on screen now is my full breakdown of what to watch the morning after the next FOMC meeting. Watch that next, because Warsh's first meeting could move silver more than any single event this quarter. Stay disciplined. Stay skeptical of anyone promising you easy money. See you in the next one.